Well, good morning. So the topic of the day is increase in surrender value to reinforce customers' faith. Increase in surrender value to reinforce customers' faith. See, people are now buying life insurance for protection, and the increase in surrender value is unlikely to impact the persistency ratio. Insurance companies have wholeheartedly supported the regulator's idea of increasing surrender value because they believe that everything that is benefiting the customer is going to benefit the industry in the long run. So, of course, this is not dissociated from change in their strategies in terms of refiling their products, reworking distribution commissions, margins, etc. But they truly believe that this will reinforce customers' interest and faith in the life insurance industry. So in the long run, it will increase the demand for life insurance products because one of the problems with the life insurance is that the liquidity has not been as good as it should have been. So with this coming in, customers will have greater liquidity in life insurance products. So it is definitely going to increase demand, and obviously that will trigger further growth in the industry. As for persistency, one has to wait and watch. Ideally, persistency should not be affected because of this only. It gives additional comfort to customers in that they can withdraw their money if required and get better value. Because the life insurance rule has changed now from 1st October 2024. Now the insured will get higher refund when he surrender his life insurance policy. So the Insurance Regulatory and Development Authority of India has asked the insurance companies to offer a higher special surrender value for traditional endowment policies from October 1st, 2024. This is expected to provide greater flexibility and liquidity for life insurance customers who want to switch policies. So there have been several reports that the insurers, including the Life Insurance Corporation of India, asked IRDAI to revise the surrender value regulations and extend the deadline to comply with the norms. However, there is no official communication or notice from IRDAI stating that the regulator has accepted the request. So in absence of any extension, the insurance companies will have to comply with the special surrender value regulations that has already come into force from October 1st, 2024. So as a life insurance policy holder, one must know that the new surrender value rule is now. How it will be calculated if they terminate their life insurance policy after 1 year, how much money they will get back. Because the special surrender value calculation is important now. See, in a master circular for life insurance business dated June 12, 2024, the insurance regulator said that the special surrender value should be at least equal to the present value of paid up sum assured on all contingencies covered and paid up future benefits such as income benefits, if any, and accrued or vested benefits duly allowed for survival benefits already paid, what's our name called, if any. So the paid up value is calculated as per a formula. Number of premiums paid into sum assured upon total number of premiums paid. I repeat the formula. Because the paid up value is calculated as per this formula now. Number of premiums paid into sum assured upon total number of premiums paid. So to arrive at the expected present value of the paid up sum assured and paid up future benefits, IRDAI has specified a maximum spread of 50 basis points. That is called BPS, basis points, over 10 years GSEC. So the applicable special surrender value shall be reviewed annually based on the prevailing yield on 10-year GSEC. So according to the earlier rules, 50% of the total premiums must be paid if a policy is surrendered between the 4th and 7th years. So you would have got rupees 1.2 lakhs back, 50% of the total premium of rupees 2 lakhs and a bonus of rupees 40,000. If you had left the policy after 4 years, according to previous surrender value norms. So with this special surrender value norms now, you will get back rupees 1.55 lakh. So if you get life insurance after 1 year, you will get higher surrender value. Till now, if a policyholder exits a life insurance policy after 1 year, he would have lost his entire premium. So with the new special surrender value norms, policyholders will be eligible to get a refund, even if they leave after the first year. So special surrender value calculated as above shall become payable after completion of first policy year, provided 1 full year premium has been received. So provided for policies with limited premium payment terms of less than 5 years and single premium policies, a special surrender value shall become payable immediately after receipt of first full year premium or single premium. The provision for higher surrender value calculated at a prevailing 10-year government securities rate with a limited spread significantly increases the value returned to policyholders in the event of a policy surrender after the completion of the first year. Let us consider another example. A policyholder bought a 10-year policy with a sum assured of rupees 5 lakh. So he pays a hefty premium of rupees 50,000 in the first year. Till now, if he leaves the policy after 1 year, he would not have gotten any refund from the insurer. He would have lost rupees 50,000. But according to the latest norms, he will be eligible for a refund even if he exits the policy after a year. So the insurer has received the premium for the full year, they have to return rupees 31,295 to the policyholder. They have to return rupees 31,295 to the policyholder. Now, how will the policyholder know about their special surrender value? The regulator has asked the insurers to mention policy-wise guaranteed surrender value, a special surrender value and payable surrender value separately in the benefit illustration. It is now mandatory for the insurers to provide a customized benefit illustration to prospective policyholders along with the prospectus while seeing a policy. So the benefit illustration must be signed by both the potential policyholder and the insurance agent, intermediary representative or insurer employee involved in the sales process. So this signed document will become part of the policy document. So you need to check the policy benefit illustration carefully to understand guaranteed surrender value, a special surrender value, and surrender values that will be paid when you return the policy. So IRDAI, that is insurance regulator, asked insurers to implement this special surrender value rule immediately. That has been implemented from 1st October. Now the question is, who gets the benefit of a special surrender value norms? This move is in favor of the policyholders. Those who are stuck with the wrong product due to rampant mis-selling that has become quite prevalent in the insurance sector will get a higher amount back now. So the new surrender value norms introduced by IRDAI will apply primarily to new endowment policies issued after the implementation of the guidelines. Now, the life insurance policyholders will get a higher refund if they just continue their policies despite opposition from some insurance companies. So the insurance companies now have to pay the higher value. They have no option. Simultaneously, there are two aspects of life insurance, uninsured and underinsured. Both problems are there in the industry. Now, life insurance is a dynamic, not static requirement. Underinsurance happens because of lack of upgrading covers over a period of time. So people should keep reassessing their cover requirement every 5 years. They should see if they have covered themselves for a minimum of 10 times their annual salary or annual income. Ideally, it should be 15 to 20 times. The second is uninsured, where people have not bought insurance. India has both the problems, and we have a long way to go in solving both these. Uninsured is being taken care of. How much through IRDAI's vision of insurance for all, where new products are coming in, including the Bima Trinity. So the intent was primarily twofold. One is that there is a lot of interest in the insurance. Now because the markets have been doing well and life insurance offers a good platform for customers who are interested in long-term returns from the market. So people should invest for a minimum period of 10 years because the longer you stay invested, the better the returns are going to be due to the compounding impact of investment. So at the same time, some customers who buy term insurance believe that if they survive the term of the policy, say 15 to 20 years, they are not getting anything back. We looked at customer research and what they believe and asked, can we look at a product that operates like a ULIP from the term perspective and a term plan from the cover perspective? So the product is such that if you invest in a ULIP for say 15, 20 or 30 years and die during this period, you will get the sum assured. If you survive, you will get a good sum as corpus at the end of the journey. So it works like a term plan, earns like a ULIP, and has resonated very well with the customers. Resonated very well with the customers. Now, from a regulatory perspective, there has been a lot of talk of players offering specific products for specific segments, niche, geographical, focused, that can enter the life insurance market. On the distribution side, continuous innovations is happening in terms of B2C models, using other channels for distribution. Now, policyholders existing traditional life insurance gets more money back starting October 1st, 2024. There have been several reports, but now this has been implemented. So, as a life insurance policyholder, you must know what the new surrender value rule is and how it will be calculated. If you terminate your life insurance policy after 1 year, how much money will you get back? So, in a master circular of 12th June 2024, IRDAI has said that the special surrender value should be at least equal to the present value of paid up sum assured on all contingencies covered and paid up future benefits such as income benefits, if any, or accrued vested benefits duly aligned for survival benefits already paid. So, paid up value is calculated as per a formula, that is number of premiums paid into sum assured upon total number of premiums paid. So, to arrive at the expected present value of the paid up sum assured and paid up future benefits, insurance regulator has specified a maximum spread of 50 basis points over 10-year G-Secs. So, the applicable special surrender value shall be reviewed annually based on the prevailing yield on 10-year G-Sec. So, according to the earlier rules, they were not in favor of the policy holders, but now, with these revised rules, policy holders will get money even if the policy is discontinued after payment of one complete year's premium. Thank you very much.